Dennis, why don't we get started?
Okay. Good afternoon. I'm Dennis Galucki. Welcome to the 441st Imagine Greater Buffalo program and our 62nd virtual Imagine lecture hosted by our wonderful Buffalo and Erie County Public Library. Thanks so much for joining us today. This program is created by ImagineLifelongLearning.com and the Center for the Study of Art, Architecture, History, and Nature, or Cezanne. We're going to start with our speaker shortly, but first, a little housekeeping. Everyone watching will be muted during our speaker's presentation. So if you have a question, please type it into the chat box and we'll get to as many as we can. This program is being recorded. You'll be able to watch it again later on the Downtown Central Library's Facebook page and YouTube channels. And we hope you share the link with your friends and networks. Now, on the 5th Tuesday of the month, we host a discussion on the art of investing. These 5th Tuesdays only happen every 3 months or so. So it's a real privilege to do this. Today we have J.D. Hartman, who's been co-hosting the sustainability program from last summer and all of our art of investing programs. As well, and JD invited a guest, Bill Davis, who will be joining us to discuss environmental, social, and corporate governance, known as ESG investing, as well as sustainable investing. JD has worked in the financial industry for nearly 40 years. His current focus is on sustainable, responsible investing. That's what he does. He is also an active member of the local Sustainable and Responsible Investment Forum and the Sustainable Business Roundtable. Bill Davis has founded or served as CEO of a number of companies over the last 35 years, including some with focus on renewable energy and converting biomass waste materials. This is an exciting topic. It's very much being discussed not only nationally, but globally. So now let's continue that discussion and welcome JD and Bill Davis. JD, take it away.
Thank you, Dennis, and the Buffalo and Erie County Public Library for hosting. Good afternoon, everyone. I'm JD Hartman. Thanks for joining us. It was about 3 years ago, Bill Davis and I met in New York City at the Bloomberg Sustainable Finance Summit. And I've come to know Bill as Dennis mentioned, the founder and managing director of Stance Capital out of Boston. He's a recognized ESG thought leader, being a sought after guest on all the financial news networks. But most importantly, Bill walks the talk. He is a daily practitioner of ESG investing, and that he and his team manage hundreds and hundreds of millions of dollars. And over the years, Bill and Stance Capital have demonstrated that investors can outperform with less risk and own companies that they can be proud of holding. Bill's here with us today to talk about how ESG works and why it matters. Bill, thanks for being here. The floor is yours.
Great. Well, JD and Dennis, thank you for having me. And it's a pleasure to be with you today. And I'm going to hopefully share my screen. Did that come through? Good. Okay. So yeah, ESG is a fascinating topic. It is everywhere these days, but it wasn't always this way. And I thought it might make sense to spend a few minutes just talking about, before we talk about why it matters, let's talk about how we got to this thing called ESG. It's a bit of a confusing space because it's a term that actually, it's not even a sentence. It's just three sort of disparate words, kind of like grouped together. It stands for environmental, social, and governance, which are three kind of discrete activity tracks that investors think about, that they try and get companies to align their behaviors around. But ESG also goes by other names. So it has been referred to as faith-based investing, responsible investing, impact investing, sustainable investing, values-aligned investing, socially responsible investing, or SRI for short. And all of these things actually are more or less defined terms that have slightly different meanings, but generally speaking, they all get lumped together when talking about ESG investing. But if you look over on the right side of this bowl of words, you'll see SRI, and a lot of what is now ESG grew out of this thing called SRI, or socially responsible investing, which, by the way, has been practiced for hundreds of years, primarily by faith-based organizations, but became sort of prominent in the 80s in response to apartheid in South Africa, and in particular, European and US colleges and universities decided to divest from companies doing business with the South African government or in South Africa. And that became kind of, I think, the first modern expression of socially responsible investing. There was a number of good things about it, actually, one of which was this idea that companies can and should be responsible for more than simply generating a profit, that they actually, for their own long-term, out of enlightened self-interest, if nothing else, they should be responsible to the communities in which they operate and live, to the employees that they hire and retain, and to a wide variety of other stakeholders. But the problem, of course, with socially responsible investing was twofold, in my opinion. The first is that it was really entirely based on screening out bad behavior. So, you say, we're not going to invest in tobacco, we're not going to invest in this or that. And generally speaking, if you don't do other things in portfolio construction, you end up underperforming the market. So that's no good. The other thing is that there was a bit of a pejorative component to it. And I'm going to come back to this later, but one of the problems, of course, with any kind of values aligned investing is that everybody has their own values, right? So if you're a portfolio manager and I'm on the investment committee of a small endowment or pension, I don't want to hear what you think I should do. I want to tell you what I want to be doing, and I want you to build portfolios that align with what I'm trying to accomplish. And so I think that the whole SRI movement sort of missed that bit, and as a result, it kind of lost a lot of steam pretty much around between 2000 and 2010. And what took over, really starting around 2014-15, is this thing called ESG, which, again, without getting hung up on what the words mean, I think that the whole idea of ESG is, yes, you do some negative screening to weed out bad companies, but generally what you're doing is you're looking to invest in good companies. So it's a combination of positive and negative screens. I think it necessarily needs to be dynamic. It necessarily needs to be based on information and transparency. And of course, that then creates all kinds of other problems, because public companies generally don't want to be transparent. They view it as a competitive disadvantage. And so there is this tension between investors and the companies that they invest in around increasing transparency. And so I bring up all this just to kind of clear up the idea that when you hear all these different terms, while they do mean different things, they all kind of, in many ways, are kind of pointing in the same direction. The United Nations created something, I think around 2010, called the Principles for Responsible Investing. They have since spun it out into its own entity, now known as the PRI. The PRI, and by the way, I believe that it has been said that there is something like $160 trillion of investable assets around the world. Well, right now there are, and this is as of the end of 2020, so this is actually already a little outdated. There's over 3,000 institutional asset owners and investors representing about $109 trillion of investable assets that have signed on to the PRI. And to be a signatory essentially says, it doesn't force you to do anything, but it does require that you at least agree to think about your investment decisions within the construct of climate risk and other types of systemic risk, which could affect investment returns over time. And a related point, and you'll see the same slide kind of buried under number 2 here, but essentially this movement towards incorporating off-balance sheet metrics into investment decisions, and those off-balance sheet metrics tend to be E or S or G in nature, is not only growing, it is, in my opinion, unstoppable. And the reason, of course, is that economies and businesses around the world are seeking to decarbonize. And in the process of seeking to decarbonize, there has been a significant growth in regulations, which actually creates more disclosures, which provides more transparency, which allows investors to essentially do more in this area. And by the way, a lot of people will say, well, look, regulation's bad. Who wants regulation? Well, the reality is the financial services industry is asking for regulations around this. They're asking for clarity for fiduciaries, within the Department of Labor as it relates to incorporating ESG criteria in investment portfolio decision-making. They're asking the SEC to take other actions. And so the reality is that the investment community, and by the way, this really gets to the heart of why this all matters. The investment community recognizes that climate risk is systemic risk that is going to affect every single industry and probably company on Earth in one way or the other. And whether we choose to prepare for it and to manage that risk is going to ultimately determine the kind of outcome that investors have. And so that's why I think all of this matters. But anyways, I get ahead of myself. So if you go clockwise from the upper left, growth and regulations creates disclosure. Combine that with the investor demand that I just talked about and investor pressures, which, by the way, aren't just around climate risk. Investors want to know how companies that they invest in are spending political lobbying dollars. They want to know what the gender diversity is within the company. They want to understand human rights disclosures. So there's a lot of things that investors are now asking for, and they are demanding through the tools that they have available to them, which is principally discussion and negotiation, and ultimately can include filing shareholder resolutions, and lastly can include divesting. But I think one of the things that detractors of ESG investing say is, well, first of all, if you divest, it really doesn't do anything because some other investor just steps in and buys your shares. That's all true, but keep in mind that most ESG investors really aren't divesting. They're actually seeking to change the behavior and to identify winners and losers and to invest in those winners and avoid those companies that are likely to be laggards in this transition. And so the last thing, of course, that's a part of this cycle is that there's a lot more assets that are being deployed in this area. And by the way, there's a lot more product that's being created in this area. And it works, right? So I will be the first person to tell you that ESG investing isn't going to cause industries to go out of business. It's simply going to create a set of winners and losers that might be different from the way the deck is stacked today. Through investor pressure, Shell last year announced plans to become a net zero emissions energy business by 2050 or sooner. Now, this is a company that basically is in the extractive fossil fuels industry. That's what they do for a living. And they do some other things, but the point that they're going to get to zero carbon or net zero emissions by 2050 is pretty extraordinary when you think about it. Another company in the same industry, Exxon, you may have heard this past summer at their annual general meeting, 4 directors were replaced by shareholders. Why? Because those shareholders were increasingly concerned that Exxon was not being ambitious enough, and that some of the things that they said that they were doing to take positive steps forward around climate risk were really being overshadowed by the things that they were doing that were going in the wrong direction. So the point is that I think we're going to get to where we want to get one way or the other. Some companies will arrive at the decision to change behaviors, other companies won't, and shareholders will ultimately lead the charge. By the way, this isn't all just about climate risk, and I should also point out that sometimes when you focus purely on climate, you end up creating or not solving other problems, which ultimately don't allow you to solve the climate problem either. So this is the UN Sustainable Development Goals. There's really actually 16 of them. The 17th is just a partnership for all the other goals. But you can see it has to do with water and waste and energy and education and poverty and everything else. And so ESG investing can be and frequently has been mostly about the E, but I think increasingly it's focused on the S and the G. And I guess the point I would make here is that it's hard to do well, right? Because the more you think about or unpack an individual business and how they behave, the more you realize, well, actually, they may be doing some things really well, but they're doing some things that are really not good and are actually causing us to go backwards in other areas. And so one of the things that we have to do as portfolio managers, and frankly, it's hard, is we have to think about the fact that businesses are like people. They are rarely perfect. And it's generally easy to identify the truly great ones and the truly horrible ones. And many of us, can do this pretty easily. We could all do this on this call if we took the time. But what we can't necessarily do easily is figure out the difference between a good company that does some bad things and a bad company that occasionally does some good things. And so one of the advantages of an ESG approach to investing is we are able to build in off-balance sheet risk factors and assign weightings to those risk factors, which create moments of discomfort. I mean, here's one example. Most of the companies with the best ESG ratings are actually not all that great around things like labor or human rights or even employing a lot of people. They're actually rapidly trying to get rid of their workforce and basically through robotics and other things and automation. And so, but that then becomes something to think about. There was a report in Barron's last spring or maybe winter talking about 50 Fortune 500 companies that don't pay any taxes. Well, I co-manage a portfolio with my partner of S&P 500 companies. And so I was very keen to look at that list, hoping that none of the companies that I invest in were on that list. And out of a portfolio of 50 names, probably 14 of them were on the list. And so you have to then say to yourself, well, look, am I weighting the not paying taxes thing appropriately? Should it have a higher weighting? Because nobody wants to, maybe investors don't want to be investing in companies that don't pay taxes. I personally think the companies have an obligation to pay taxes. It doesn't mean that they have to be foolish about it, but the reality is taxes pay for a lot of the things that we require in this country. And so ultimately, though, what we did was what we had already done is we had assigned an overall weighting to taxes paid. And it tends to be a relatively small percentage because which is more important, paying taxes or human rights or diversity of management or carbon emissions? All of these things are important and we have to weight them. Last point I'll make really quickly, and then I'm hoping we can just, JD, you and I can chat and then we can pull everybody else in. But this is, in the US, we tend to think that everything's kind of like US centric. The reality is this movement towards investing in better companies, let's just call it that, is really a global thing. And it's mostly a European thing. And you can see that for a long time, it really wasn't much of anything. But beginning around 2015, which by the way, is the moment in time when within the S&P 500 anyway, you got to more than half of the companies actually filing annual corporate sustainability reports. So there was data for portfolio managers like me to mine. But ultimately, you can see that the pace of growth of this type of investing, and by the way, this is only passive investment funds, so this would be ETFs and other sort of passive vehicles, is really growing extraordinarily fast. In the US is really just beginning to get into the game. And I would say this has been over the last 3 or 4 years. The rest of the world outside of Europe hasn't caught up yet, but it is becoming very important to big investors as evidenced by the PRI memberships. It's becoming incredibly important to small investors, especially younger investors who stand to inherit some $30 trillion of inheritance over the next decade or so. And so this movement is not going away at all. And I'm going to stop right there. And JD, I'll turn it over to you.
Great. Thanks, Bill. Yeah, always some great insights. Much appreciated. You mentioned investors a number of times, and I'm out with the investor community. And when I'm in the conference room, boardroom of a small to mid-sized foundation or endowment, and they get the economy shifting, toward to decarbonizing. They get that. They get the reasons because of the press around the climate change and then the move to electric vehicles. It's anyway, but what they don't like, but that's not most of the organizations that I deal with. That's not their mission. Their mission is more around social justice and all, like, I'll say handguns. Okay. Gender equity and so on and so forth. Can you talk a little bit about how you said, hey, so I'm picking winners and losers in this shift to a low carbon economy. But how do you pick winners and losers in handguns or conventional weapon systems, or those companies that are either good or bad actors in diversity, for example?
And
Sure.
Bill, before you answer that, let me add to JD. You're dealing with, typically in a group like that, a group of people. So that how do you encourage them to articulate their values in a way that you can respond as a portfolio manager legitimately to their concerns? How do you invite that to happen?
Well, and I think the answer was in the question, Dennis, because you do invite them to tell you what they think. And I think that's kind of new in financial services. Like, for a long time, there was never a conversation. What do you care about outside of preserving or growing your wealth? I mean, that was never a conversation. And I think now it is a conversation, and it's an appropriate conversation. And it's relatively easy if you're talking to an individual or maybe even a family, not always, but I think it gets harder as it gets more institutionalized. And JD, to your point, what do you do when you've got let's say a nonprofit social services organization whose mission is to, I'm just making this up, but to help children, and they've got funds to invest. And so what does that really mean? Like, how do you incorporate their values into investment portfolios? And that is the really fun and interesting part of this, because that's where everything is headed. Like, one of the comments that I say all the time is that ESG is values aligned investing on training wheels, because it is ultimately, like, I build a portfolio, and ultimately I was the first client of the portfolio, and therefore I built the portfolio around my values, right? So that's how a lot of this stuff gets built. And I didn't want to invest in weapons. I didn't want to invest in tobacco companies, and I didn't want to invest in thermal coal specifically, to draw a distinction between that and metallurgical coal. And that was what informed kind of how I thought about this portfolio. But now we're talking to clients who tend to be small institutions, and they're saying, well, what we really care about are women and girls, or we really care about human rights. And so what we ended up doing, and this isn't intended to be any way a promotion of what we're doing, but what we ended up doing was building portfolios in a way such that almost everything is automated, which means that if a client has a different ethical lens through which they are viewing the world, we can incorporate their views and essentially substitute their views for mine, right? And there's 3 parts to portfolio construction for us. 2 of them remain constant. One is focused on fundamentals, one is risk optimization. But before we get to either of those things, there's values alignment. And so we have the ability to actually build portfolios that align with individual clients' values. Now, you can't really do that for a $100,000 retail investor. I think the robos will figure out how to do it, and I know some already are. doing that. But I think when you're talking about a $5 million, a 10, a 20, a 50, $100 million slice out of an endowment, it's very easy to do because you simply do it in something called a separate account. So it ends up not being a mutual fund or an ETF or a pooled vehicle. It ends up being a collection of individual securities held in an account. And I think that's really the key. And I think that getting to that investment policy statement is absolutely critical. And there's some very good ones. By the way, if folks are interested, there are some of these things are published by nonprofit organizations in the US and, by the way, in Canada, which has been much more like Europe in the sense that they're probably 8 to 10 years ahead of the US as it relates to thinking about sustainability and incorporating it into their investment portfolios. So it's relatively easy to go fishing and to find examples of other investment policy statements that have been developed by other not-for-profit organizations. And I think that's really the key to all of this. It's got to start with what is it that you're trying to accomplish beyond simply protecting and growing money, because what we have now learned is that you can do more with your money than just protect it and grow it. You can have a second set of goals, which are values, oriented in nature.
Bill, could you give us a rough site location for those investment policy sample statements that you alluded to?
I think one of the best ones I've seen, and everybody can either write this down or maybe somebody can post it in the chat, but there is a community foundation not too far from you guys up in Toronto called Inspirit Foundation, INSPIRIT. I think it's all one word. And on their website, or it's either on their website or somewhere, you can actually find their investment policy statement because it's published. I've seen it, I've read it, I thought it was good, and I've actually shared it with other people. So it's discoverable.
Good, thank you.
Hey, Bill. So I help organizations build, as well as individuals, build their investment policy statements. And there's always a little bit of skepticism. Is this really doing anything? Like, hey, it could be reducing or managing the risk. My returns are as good or better, so that's all good. But is it really accomplishing anything? I know you have some KPIs or key performance indicators. Can you just focus on one, whether it's about carbon footprint or otherwise, gender at the executive or board level? What type of, like, hey, we have 20% more women represented in executive positions. Some KPI that I have to use them to convince people it's not perfect, but it's better.
Well, right. And yes, I do. And I'll give you a very specific example. But before I do, I think it's worth noting that these should be dynamic, right? Because the world is changing. We have about as long a track record in the ESG space as anyone. And in 2014, when we got that track record going, I think we had 10 key performance indicators, which for those of you who aren't familiar with that term KPI, think of them as off-balance sheet material risk factors. So that were E, S, or G in nature. And today we have 24, right? And that's in 8 years. We've increased substantially the number of these material risk factors that we're looking at. The most recent one, and this is why I'm going to share it, came about during COVID, or the risk factor didn't come about during COVID. As a portfolio team, we got together right after Q1 of 2020, which was obviously a tough year in the markets, or a tough quarter in the markets. And we said, look, we did actually quite well. How do we be more resilient in the face of a pandemic? Because frankly, we didn't really build this portfolio thinking about a healthcare pandemic. But what we came up with was that paid sick leave, interestingly, is something that we had never tracked. I wasn't aware of other ESG managers that were tracking it. And so together with our outsourced ESG data partner, we sought out how do we gather information from companies on their practices as it relates to paid sick leave. Now, to be really, really clear, in many industry groups, it's probably not a material risk factor. But let's take meatpacking as an example. If you've got an industry where you've got many people who are not highly paid, working in close proximity, who don't have really any kind of financial safety net, and somebody comes down with COVID, what's the first thing they're going to do? They're going to probably go back to work because they need the paycheck. And so in certain industry groups, not only is it really the right thing to do, but from a portfolio manager's perspective, I can better manage portfolio risk by actually having data points which would enable me to avoid investing in those companies who are going to miss their quarterly numbers because they had to shut down their manufacturing or processing facilities. So it comes back to portfolio risk at some point.
Thank you. That's a great example. Hey, Melissa, any questions from the attendees?
Yep, there is one question. So does the corporate governance assessment process for assessing ESG status for an individual stock include updating for significant insider legal stock sell-offs, as we have seen with the Microsoft CEO's recent sale of half of his Microsoft holding? Such insider sell-offs may affect investor value of such an ESG stock.
Yes, so I would say that's an interesting question. I would say that even before ESG investing came along, investors have been looking at insider activity for quite some time. So it's sort of a well-known and practiced factor. And generally speaking, you can get burned by it because you can be on the wrong side of that trade. Because, for example, people sell stock for all kinds of reasons. But there was the recent Microsoft issue. There was also Elon Musk, who sold an awful lot of stock. Although, if you unpack that, much of his stock sales were going to pay a tax bill. So I think that I tend not to think of it as an ESG issue, but I would say that that portfolio managers, but we do look at it. What I was going to say is we don't look at it from an ESG perspective. We don't view it as a material risk factor that is governance based. However, we do look at it as a factor, a fundamental financial factor that could ultimately affect a stock's performance.
I'll address this to either one of you. Melissa, let me know if somebody else comes in with a question. But performance is what trustees or individuals want. And the logic in the 80s, which I do recall very much, that if you reduce your universe of possible investments by just one, you therefore somehow are impacting the potential for your investment return. In the end, I don't think that's accurate. There's thousands upon thousands of opportunities. And the trick of being a portfolio manager is finding the right ones and weighting them properly, obviously. But could you at least make sure that we in this program address the fact, are we really giving up performance in any way by trying to add all these other measurements into the sale along with performance?
I'm going to let Bill answer that question because he's, anyway, I do want to second that nobody hires me to underperform, values-based or not. So it really is critical. So Bill, what's your answer to that question?
Yeah, well, I think it's in order for the ESG industry to gain momentum, it first needed to be able to prove that you can do all this stuff without negatively impacting performance.
Right.
So I would say that there is sufficient empirical evidence based on now, let's just call the industry in the US 8 years old, because we were one of the first people in it and we got our portfolio going in 2014. And I think we're actually underperforming this year, but we've outperformed over 3 years, 5 years, and since inception. So we basically have proven that you can actually outperform the market with less risk and volatility. And I would also point out that in our particular case, we're doing it with a beta of 0.82 since inception and a down capture of 70%. So not only are we outperforming on the upside, we're outperforming on a risk-adjusted basis by even more than we are on an absolute basis. And so I think that the real point to make is that it's relatively easy now for active managers to build portfolios that generate competitive returns and can also add in all kinds of risk management components into the construction so that they're actually better prepared for down markets. I think that there is something really interesting in the ESG space, which I think is maybe a bit of a ticking time bomb. And I'm glad I've got this passive fund slide still up here. And the reason why is that if you look at the S&P 500, just as an example, it's obviously the 500 and I think 4 now largest companies in the US by market cap. It is also market cap weighted, and it's incredibly concentrated. There are, I think, 7 names in the S&P 500 now that account for 23 or 24% of the overall index. All of those 7 names, I think, are mega cap tech and comm services companies. So just think of them as big tech companies, or FANG stocks if you prefer, plus Tesla and a few others. And so I think one of the potential issues for the ESG space is so much ESG product is growth oriented and overweight tech, that if there is a big tech correction, you're going to see a lot of these passive funds really, really tumble. Because I think when people buy an S&P 500 fund, they've been trained to think, well, I'm diversifying my portfolio. Well, you're not really diversifying it if half of your holdings are in 40 names, most of which are tech companies. So it is worth look, ESG is such a broad space, and everybody gets to define it any way they want, including portfolio managers and investors. And so you've got things that have, let's just call it, varying degrees of authenticity, varying degrees of concentration. And it's very important for investors to really, be they individuals or institutions, is to really kind of look into the hood and see what it is that you're actually investing in. Because on the one hand, you want to invest in companies that you believe in, but on the other hand, you do want, and I think need, some level of diversification, unless you're just simply making sector bets.
Well, we're going to have to wrap it up pretty soon here. JD, a final thought that you have?
No, just that 2 things. One is Bill's a gem. Thank you so much. But also, Bill's not alone out there. So this Bill is representative of a trend, and to me, it's a positive trend that bodes well for not only returns, portfolio management, risk management, outperformance, but also for the world in general. So thanks again, Bill.
Yeah, one thing I would love to add, if I could, just very quickly, is I think that we're in the very early stages of all of this, and much of the emphasis has actually been on carbon risk for pretty obvious reasons. But I think that the next major emphasis is going to be around social equity. And I think that we're going to see lots of investment products built that really kind of challenge this notion that fixed income needs to be buying the Barclays Ag as opposed to investing in local communities. And I think some of it is structural. I think we don't have the products that we need that we're going to have. But I think that there is enormous pent up demand to build stronger social fabric and safety nets, and to do it through investing.
Things
so
don't
that's what I
happen.
will leave with. And thank you. Thanks so much for having me. It's been a pleasure to join you today, and happy to come back anytime.
Bill, and it would be remiss of me not to at least point, you're not here in Buffalo. You're not in Western New York. Tell us where home is for you and where your company is located.
Yeah, so Stance Capital is based in Boston. I actually happened to be down in the west coast of Florida today. I came down to help a friend of mine move a boat. And so we did that this morning, and I'm doing this right now. And yeah, but we're actually based in Boston.
Good. JD, thank you very much for bringing in a speaker like Bill. The Imagine series, Imagine Buffalo, nothing happens, folks, unless we move to a point of investing in it. Then it has a way of happening. And everybody's an investor. They just don't tend to think or appreciate that they are. But one way or the other, retirement plans through organizations that we get involved with, we're all investors. So that's why we do this series, The Art of Investing. And we'll continue this discussion. Sustainability will continue every last Tuesday of the month. But The Art of Investing, March is the next one in next year to have 5 weeks. So JD, we'll see you back for any of those sustainability programs and certainly the one in March. How was that? Thanks again, Bill. Now, folks, we thank you for joining us today. Plan on joining us next week, same time when we talk to Monsignor Paul Burkhart about Our Lady of Victory Basilica and their 100th anniversary. It starts here in 2021 and continues for the next 5 years. That's the time it took to build that wonderful facility. You're going to be in for a treat. The show next week will start with a drone doing the exterior of the basilica, and then as the doors open, it will fly right into the interior, and you'll get a wonderful 360 view of that magnificent edifice of Our Lady of Victory Basilica. So join us if you can. Tell others about this. Again, thanks for being with us today. I'm Dennis Galecki. Have a good day and be well.